Welcome to This Explainer. Okay, so my goal today is incredibly simple, but honestly, it's pretty ambitious too. We are going to totally strip away all that complex, intimidating jargon to build a highly practical, working framework of exactly how money works. Because whether you're just trying to manage your own wallet or you want to understand how massive global markets operate, the foundational rules, they are exactly the same.
Just think about that for a second. What if everything, literally everything, from your monthly paycheck to the inner workings of Wall Street, from interest rates to stock options, could be totally decoded without having to crack open a single dense textbook or, sit through some incredibly boring lecture? Well, today we're focusing on the raw framework that powers every single dollar, every business, and every economy on the planet.
When you really boil it all down, this right here is the ultimate definition of finance. It's simply the study of how money moves through time. That's the whole shebang. Time is absolutely the secret ingredient here. It introduces this core concept we call the time value of money. And that is the absolute bedrock of every financial decision you or a multi-billion-dollar corporation is ever going to make.
So let's map out our journey for today. We are going to start with the core of finance. Then we'll move into your personal finance playbook. After that, we'll explore markets and the system's plumbing, take a look inside corporate finance, unpack the risk-reward trade-off, and finally, we'll dive right into the psychology of money.
All right, diving into part one, the core of finance, which is all about time and uncertainty. Let's start right at the foundation. We need to establish the most absolute, ironclad rule of all financial decision-making. A dollar today is worth more than a dollar tomorrow. Why is that? Well, because a dollar today can be invested and it can grow. If you've got a dollar in your hand right now, you can put it to work immediately. But if you have to wait a whole year for that same dollar, you've literally lost a year of potential growth. Plus, you've taken on the uncertainty that you might not even get it at all. I mean, things happen, right? Companies go bankrupt, people default. So time and uncertainty are the two key elements in finance. Actually, every valuation of every asset out there is really just figuring out how much those future cash flows are worth right now, today.
Moving on to part two. Your personal finance playbook. This is how we actually manage your money. So the paycheck hits your bank account. Where does the money actually go? Finance absolutely loves a simple rule, and the 50-30-20 budgeting rule is just a brilliant starting point. Basically, it suggests allocating 50% of your net income to your needs, the absolute essentials you have to pay, like rent and groceries. Then 30% goes to your wants. These are the discretionary things that make life fun, like dining out or your hobbies. And finally, a super crucial 20% goes directly to savings and investments. Now, is it a perfect rule for every single person? No, of course not. But it gives you a highly effective, immediate framework to completely regain control of your finances.
But listen, before you invest a single dollar of that 20%, we really need to talk about this number, 18%. That is very often the interest rate just sitting on your credit card debt. Eliminating 18% high-interest debt is the exact same thing as earning a guaranteed 18% return on an investment. And let me be perfectly clear here, there is no investment in the world that can reliably beat that return. This brings us straight to compound interest. Albert Einstein supposedly called it the eighth wonder of the world, and he wasn't wrong. When compound interest works for you with your investments, it's literal wealth-building magic. But when it works against you in the form of debt, it is a catastrophic financial trap. The math is exactly identical. The direction is everything.
Okay, part three, markets and financial plumbing. Let's look at the broader financial system.
Let's zoom out from your personal wallet for a second. Financial markets and intermediaries sit right at the center of the universe here, basically acting as the plumbing for the whole system. They connect individuals who have money they want to save with firms that desperately need money to grow. Banks are a great example. They take in deposits and they make loans. Thanks to something called fractional reserve banking, they actually only keep a tiny fraction of those deposits in reserve and they lend out the rest, which effectively creates money. And the difference between what they charge their borrowers and what they pay their depositors, that's their profit. It's just this massive, continuous flow of resources across time and across radically different states of the economy.
Now, as this money flows through the plumbing, it lands in different vehicles, or asset classes. You've got your stocks, which represent actual ownership and higher risk in a company. You have bonds, where you're essentially acting as the lender to a government or a corporation in exchange for a safer fixed return. Then there's real estate, which benefits from leverage, but is, pretty illiquid. Mutual funds and ETFs are amazing because they let you buy a diversified basket of stocks, so your whole portfolio isn't relying on just one single company. Commodities cover physical goods like gold and oil. And finally, we've got highly speculative digital assets like cryptocurrency. The massive secret here? Diversification. Spreading your money across all these different assets reduces your risk without necessarily reducing your return. In the finance world, diversification is pretty much the closest thing you'll ever get to a free lunch.
Let's move on to part 4, inside corporate finance, and how these companies try to maximize their value.
So, we know how the markets move money around, but what actually happens inside the businesses that are putting this capital to work? Well, their ultimate objective is super simple: maximize their current market value. To pull that off, corporate financial managers have to make 3 incredibly massive decisions. First up, the investment decision. Where exactly should they deploy their capital to generate the absolute best possible returns? Second, the financing decision. How are they going to fund themselves? They can take on debt, which is generally cheaper but adds a lot of financial risk, or they can issue equity by selling shares. Finding the perfect balance there is key. And third, the dividend decision. What do they do with the profits once they make them? Do they pay dividends back out to the shareholders, or do they reinvest that cash back into the business to fuel future growth?
And to keep track of all this, every single company tells its complete financial truth and tracks the results of those 3 big decisions through 3 core statements. First, the income statement, which shows profitability over a period of time. It's just revenue minus expenses to get your net income. Next, the balance sheet. This is like a snapshot at one single moment in time, proving that what a company owns, its assets, equals exactly what it owes, its liabilities, plus shareholder equity. And finally, the cash flow statement. This one is vital because net income is not the same as cash in the bank. A company can be wildly profitable on paper, but still run entirely out of money. So this statement tracks the actual physical money moving in and out of the business doors.
All right, part 5, we are looking at the risk-return trade-off, the ultimate balancing act.
So how in the world do we value all of these different assets and corporate decisions? We do it by navigating the most fundamental trade-off in all of investing. Think about it. Risk is simply the uncertainty of an outcome. Return is your financial gain. The ironclad rule here is that higher investment risk absolutely must offer a higher expected return in order to attract investors. If you go buy a risk-free government bond, your return is going to be low, but hey, it's guaranteed. But if you invest in some risky private startup, your potential return has to be substantially higher to justify the very real possibility that you might lose everything. You literally cannot have high returns without taking on higher risk. It's just how the game works.
To put a real, historical number on that trade-off, let's look at 10%. Historically speaking, the S&P 500, which is an index representing the largest publicly traded U.S. companies, has averaged roughly a 10% annual return over the long run. Now, the stock market is incredibly volatile, right? It crashes, it spikes, it is filled with day-to-day uncertainty. But this historical data proves that taking on that equity risk can pay off tremendously, provided you have the patience to just give it time.
And finally, part 6, the psychology of money, otherwise known as behavioral finance. Okay, so we've covered the math, we've looked at the markets, and we've gone through the models. Now it is time to introduce the ultimate boss level of finance, human psychology. Because, surprise, surprise, we are not perfectly rational actors. Behavioral finance is the study of how our messy psychology actually drives our financial decisions. Let's do some rapid-fire biases here, starting with loss aversion. Humans actually feel the pain of a financial loss roughly twice as strongly as we feel the joy of an equivalent gain. This emotional flaw makes investors do terrible things, like holding on to losing stocks for way too long, just hoping they bounce back, while simultaneously selling winning stocks way too early just to lock in a tiny little emotional victory.
Then, of course, we have overconfidence. I mean, most investors genuinely believe they are above average. Statistically, yeah, most of them are completely wrong. This creates a really dangerous false sense of security that leads to overtrading. People are constantly buying and selling, trying to time the market perfectly, which just racks up massive fees and, historically speaking, totally destroys long-term portfolio returns.
And then there's herding. When we're uncertain, we instinctively tend to follow the herd. We pile into investments simply because everyone else is doing it, completely ignoring all those fundamental financial statements we just talked about. This herding behavior is exactly what creates massive market bubbles, think the dot-com bubble or the 2008 housing crisis. We literally trick ourselves into believing the 4 most dangerous words in finance. This time it's different. Spoiler alert, it almost never is.
Oh, wow. That brings us to the end of our explainer. We have journeyed all the way from the time value of a single dollar to the complex psychology that drives global markets. Ultimately, finance isn't really just about money. It's the science of decision-making under uncertainty. And you now have the fundamental playbook. The framework is right there in your hands. So I want to leave you with one final question to think about. When you look at your own personal financial playbook, are you actively making informed choices? Or are you just following the herd? Take control and start building your future today.